But now it's time to bring in our next guest. That's going to be Bill Baruch, president at Blue Line Futures. Welcome back to the show, Bill.
Thanks for having me. It's always a pleasure to join you.
All right, Bill. So give me your take here on the equity markets. I just kind of had a tracking stock up there. 83% of the S&P 500 companies above their 50-day moving average. But it just seems, that lull in September we typically see kind of got pushed to the side as we continue to move higher.
You said it. It got pushed to the side, but I do think there's a bit of exhaustion here. I wouldn't get too excited about the late day ramp yesterday unless we can start to really close out above 58.30 in the futures. Now, just from a regular landscape, just traditional technicals here, the July high was taken out and we've been closing above it fairly consistently.
Right.
And typically that means higher highs are coming. So, I am just a little cautious here right now. I'm typically not always cautious, but it was a big move out of that early mid-September low. And then I think front running some of the expectations from the Fed cut. And another dynamic is the last two elections, 2016 and 2020, we've seen a tremendous bull market come out of those elections after the uncertainties were removed. And I think some of that's being front run too. So I just think a pullback would be healthy and consolidate. And I still have a target looking at the end of the year, 6,000 S&P.
Yeah, I think that's what everybody's kind of waiting for. But we've got that mentality now, Bill, or at least that's what I see in the equity market is like any little dip, they're scooping up. There's so much money on the sidelines coming into equities, maybe with interest rates falling. They're pulling their money out of money market funds and such and trying to get, catch the last leg of this rally. But, when you say 6,000 for the S&P 500 by the end of the year, what do we do after that? Because as you mentioned, it looks like the equity market and traders and investors are kind of front running this election.
I agree. I think they are front running the election. And for me, a lot of the times, it's not necessarily about an upside target, but it's about constructive, response to support levels. And, one of the big levels that I have right now to the downside is about 57.25 in the E-mini S&P futures. And as long as you really stay out above there, and if any pullback really stays out above there, I think it keeps stoking higher prices. Now, with that said, I think whoever comes into office next year, usually the second year of a presidential cycle is where the market pulls back. But we all know there's been tremendous fiscal spending. So I just don't know from a policy standpoint if any of that gets reined in. That could be something to keep an eye out. But all things considered, I mean, the probabilities, the momentum, the earnings growth. I mean, things we've seen, these point to higher stock prices. I just try to play devil's advocate and poke holes in what we've been seeing. But what we've been seeing is it tells us that the market should continue on this path higher.
Yeah, when it gets lopsided where everybody becomes a bull is when I start getting worried. I've been in this business a long time. So, but that being said, the economic data is there. Even with Powell's commentary yesterday, Bill, what was your takeaway from that? Because he kind of pivoted away from what the market wants, right? A 50 basis point cut in November, and basically said, hey, we're going to do 25 basis points 2 months in a row, most likely, dependent on data. What was your takeaway from his comments?
You know what? He likes to be a little bit, I call it Jekyll and Hyde. You get this, more dovish response during a meeting or vice versa, and then you get a little bit of it reined in between meetings. I think that's what we're seeing here right now. I mean, they're not going to lay out just. They've talked about it, the market's reaction function. They're not going to go out there and say, we're going to cut another 50, come November, or cut another 50 come December. I think they want to remain data dependent. They know that inflation's on that path. It's disinflationary right now. And if housing continues to come in, they're going to be at 2% or below 2%. There are obviously going to be some hurdles. And you look at this longshoreman strike, what does that do to growth? What does that do to inflation? So there's going to be questions. There's going to be, little hurdles that pop up. But going back real quick to the market in general, let's not forget in August, we had a VIX that spiked to 50. And, in the aftermath from that, I compare that to February 2018 as well as August of 2016. And we've seen the market really come out of those big 50 spikes on the VIX to go on to new highs. But there's been some tremors, some trickle effects in the aftermath, a few months out. So we'll have to see how things set up here and, come in the turn of next year, too.
Yeah, these rebounds are becoming really quick, too. We mentioned at the beginning of August when we fell, August 5th, And then you go into first week of September, we fell. They get bought. These dips are getting scooped up relatively quickly. But you know what, Bill, we've got the dollar spiking higher today. But then on the flip side, we still got gold just below all-time highs. What's your take here on the gold trade? Because it seems like the bugs are remaining in control at this point.
Yeah, we run two commodity trading advisor programs called CTAs. Both are very heavily focused in the metals. It's been, September was a great month. It's been a terrific year. One of the programs closing up about 30% year to date, and to finish out September. And I mean, we've really enjoyed this move. But I'll tell you what, when we were testing and trading above 2,700 last week, it just really felt. It felt too good. It felt too good. So we actually, I don't really remember very often, I don't think at all this year. I got flat. I think I think it was the first time this year it really had no positions in the final week. But this pullback here, I think it's, I'm welcoming 2,600 just from a little overheated market, and that's where the big support and line in the sand is now going to be. But really, this is a breakout, and I've been targeting about 2,890, 2,900 in gold. I mean, there's a number of real good tailwinds here from geopolitics, the Fed's cutting trajectory. I mean, again, you asked about Powell. At the end of the day, the Fed rate is still at 5%, and inflation is moving towards 2%. And PCE has been below, core PCE has been below 3% for 9 months running now. So I think that the gold is really sniffing that out. But to the other end, do these cuts start to reinvigorate some inflation at some point next year? And gold is always sort of front run seeing renewed inflation as well. So it's going to be a very interesting trade here in the weeks to come. But I think silver, talking about gold, you can't talk about gold without silver. And silver certainly has some catch up to do. There's real life in silver right now. I'd like to see it really decisively get out above 33 bucks in this December contract, and see $35 to $40 here before the year's over.
Yeah, it had ticked above there late last week, and then fell immediately. We've seen a little bit of a resurgence in copper also. We'll see what the impact to that stimulus over in China does for maybe some of those more industrial metals here moving forward. But we can't talk inflation, Bill, without talking crude oil. It seems like there's a lot of things out there that could propel oil higher. But at the same time, is this a demand issue at this point or an oversupply issue as the U.S. hits record production, where we just kind of push aside all the geopolitical risks and just focus on demand and production?
You're right. There are a number of factors out there right now that could force crude oil higher, but there's also a number of factors out there right now that could force crude oil lower. And you mentioned the demand factor. You mentioned some of the global growth fears. Now, China did come in with some tremendous stimulus, and that really didn't do very much to crude oil because there's fear that Saudi Arabia could come out and really try to regain market share. That is the elephant in the room right now. What does Saudi Arabia decide to do in the coming months? Do we get some news this week on that? I like crude. All things aside, I want to be long crude at these levels until it really breaks down. So we have some defined risk call spreads on. We've gone out to January, $75, $80 call spreads. I think there's some decent value there. It gives you enough if this thing really gets going. Even today, when we were down this morning when I woke up at about 4 a.m., I threw some calls on the 72.50s for November, just looking for a rip back here today into tomorrow maybe. And again, all things aside, I like what we've seen from some of the names. Exxon looks great. Kinder Morgan looks great. So across the energy space, I think there's some really interesting things to look at right now. But again, the wild card, the elephant in the room, is what Saudi Arabia decides to do. Yeah, we've had support around $65 a barrel. Does it get down there? A lot of people are calling for that resurgence. I like that idea, Bill, going out in duration a little bit if you think oil is going to rebound into early next year. All right, great discussion, Bill. Have a great day. Thank you.
All right, that's Bill Baruch, president at Blue Line Futures, breaking down some of the commodity markets.